Today, we are delighted to have Jason DeSena Trenner with us. Jason is the chairman and CEO of Strategas Securities and chief investment officer of Strategas Asset Management. Jason is a thought leader on markets and economic policy. Thank you so much for joining us today.
It's my great pleasure. Thank you.
One of the questions that I think at the top of a lot of investors' minds is, that collapse in the S&P 500 in April was truly shocking. Um, I think you could argue that what was even more shocking is the massive rally, and now all of a sudden we are at new highs and trying to seemingly making new highs every day. What do you see for the second half?
Well, I have to say it's hard to get really optimistic about multiple expansion from here because the market's trading at about 22 to 23 times earnings already. But the expectation for earnings growth this year for the S&P 500 is just shy of 10%. The expectation for earnings next year is about 13%. And so it seems to me the market's headed higher. I mean, my heart tells me it's headed higher. I don't yet think it's a blow off top like you saw in 99 or 2000, because some of the sentiment indicators that we look at are not, believe it or not that extreme. There are some elements of the market today like trading in meme stocks or 0 days to expiration options, so on, that seem a little frothy, a little speculative. But I think on the whole, for the S&P 500, the large cap stocks, I think they're more likely to go higher than lower.
Just following up on that, with the recent trade deal, 15% with Japan, and now the EU, which was, being somewhat difficult, going for 15%. Would you say that the worst of the tariff fears might be behind us? I mean, we still have to, some big names to deal with. But have we gone through the hardest part of the, sort of the tariff narrative, would you say?
I think so. I mean, China's still out there. It sounds like we're relatively close, but we don't know. But I would argue that in terms of a lot of the large countries, I think the worst, if you will, in terms of the uncertainty, is starting to be behind us. And so, again, giving the caveat that China isn't yet set in stone, which is a biggie. But by the same token, I do think that at the margin, clearly the market is reflecting the idea that the worst is behind us. And I think that's the right way to think about
Do you think that will it seems like corporate America, and then maybe if you look at something like continuing claims, at multi-year highs and holding there, seemingly suggesting that while not a lot of people are necessarily getting fired, certainly in the private sector, not a lot of people are getting hired. Do you think this will be enough to get corporate America, more willing to invest in the second half? Like, the horizon is clearing, so to speak.
it. Yeah, I mean, I think that there are things in the one big beautiful bill. There are elements in that bill that, in my opinion, are extremely pro growth. So you have full expensing of research and development, of factory construction, of capital spending, and I think that's very powerful. And I'm of the view that those things tend to come with them employment. The decision to employ more capital, physical capital, is usually accompanied by the decision to hire more people, and hopefully your capital investments are very productive, and they work out well. And I think as the kind of the dust is clearing here, and you have more certainty about what's going to happen on tariffs, coupled with some of these incentives of the tax code, I think personally, I think you're going to see the employment situation stabilize. One of the things I think that's underappreciated is that we do have we had essentially open borders for about 4 years, and we don't have that anymore. And so the labor pool is shrinking a bit because some people are going back home. And so I think that's one other thing to kind of think about. There is a sense in which you don't have to produce a lot of jobs to keep the unemployment rate relatively low.
Certainly true. I think we saw that last month when the unemployment rate, U3, surprised, sharply lower at 4.1 because participation was substantially down. I'd like to shift gears. There's a question that I've been thinking about, and we don't seem to get very very good or thinking or explanation about it. And I'd like you to help us out a little bit here. Starting with when our reaction to Russia's invasion of Ukraine, when we froze them out of SWIFT, part of that seems to have the effect of scaring a lot of countries. They're saying if we do something, and particularly China, that if we do something the U.S. doesn't really like, we could be subject to the same, same punishment or penalty. And one of the things, I was a gold trader for a long time, that started the big gold run higher. That combined with Trump's tariffs, against sort of trading partners as well as allies, there's a lot of talk about how America is not the destination to invest anymore, and you've seen that in the bond market doesn't seem to rally like it used to, at least the long end. And then the dollar has had barring today, had one of its worst years in recent memory so far. Do you think the combination of these two things has changed the way that global investors are thinking about the United States as a destination for their capital?
Well, I think that's true. I think you've seen big purchases of gold from central banks, and you've also seen the dollar down so far this year. It bounced a little bit on some of the trade news, but it was it was down about 10%. So I think that's fair. By the same token, I would argue that it's really difficult to displace the U.S. dollar as a reserve currency, and that's because it has the strongest military, and I would also say it has the most exciting companies in the world. It has the productivity and the innovation that is hard to find in other places. And so, throughout history, it's generally been the country with the strongest military that's also possessed the world's reserve currency. And I don't see another alternative that's particularly another fiat currency that's particularly attractive. You mentioned gold. Perhaps we'll get back to that later, but I'm quite bullish on gold.
Let's get to it right now. In terms of alternatives, something like gold, um, crypto, do you see, if it's not another fiat currency, something else that could at least be a rival of sorts for the dollar as a safe haven, as a store of value?
Yeah, no, I think that's fair, and I think, frankly, it's a hedge against all fiat currencies because, for the most part, I don't know. I'm trying to think of too many large countries that are or blocks that aren't running perpetual budget deficits. I don't see anyone that's kind of gotten religion on that. Some are worse than others. Some countries are worse than others. But over time, that means you're going to have to issue more paper. That means that you'll get higher interest rates and weaker currencies. Generally speaking. So, in my opinion, I like gold quite a bit. It may be a generational thing. I can't say I really understand crypto. Um, I I wouldn't short it for, you know, on my life. It's probably going to go a lot higher, but I do know a little bit about gold. I've been following gold a little bit for, I'm not an expert, and so I think gold is less overbought. Let's put it that way than crypto, where there's been a feeding frenzy in crypto, and there hasn't been that really in gold, despite the fact that it's hitting new highs. Again, that may be maybe a generational thing.
I think I agree with you. I have a modest allocation in crypto. it's going to stay that way, and someday hopefully it'll be a larger allocation of my portfolio. But you can't short it. You could argue that Bitcoin might be the only thing that they don't make any more of ever, according to plan.
Right. And, and again, every, almost everything in the world, the price of almost everything in the world is what somebody's willing to pay for it. And, gold is a little bit different because there is some sort of physical product there that you can hold on to. Crypto is a little bit more, ethereal. But by the same token, I think people tend to view it as a store of value, and it's gotten more street cred, if you will, over the last several years because it's of its staying power. And I think there are a lot of people that, myself included, that thought that it was going to be something that would be come and go, and it stuck around. And of course, so it's again hard to short, and I think it's going to stick around for a while.
It's hard to not talk about the Federal Reserve. The Fed and certainly President Trump are at loggerheads, or have been at loggerheads for a little bit of time. And it seems that if you're diving into the employment and the employment report, that there's a lot of public hiring, but not a lot of private sector hiring. Is the Fed skating close to a policy error here? Trying to hold until they make sure there is no inflation.
I don't think so. I know that's not a popular view. Most people in our business want easier money. Certainly, there's no president I ever knew that didn't want easier money, or politicians want easier money. But if you have any sort of acquired wealth, you would probably rather have hard money rather than soft money, right? As we've had. Right now, the real Fed funds rate is about 1.7%. The long-term average is 1.6%. And I just look at what's going on, and it's hard to say the Fed is too tight. I mean, if you look at the stocks hitting record highs, credit spreads tight as a drum, meme stocks, 0 days to expiration options, all these things, Bitcoin, it would be hard to say that at least financial conditions are too tight. And again, that could be a Wall Street, Main Street thing, but I'm sure that I'm sure that the Fed is looking at that as well, and being cognizant of not fueling this too much by rate cuts that aren't particularly necessary.
You could also argue that with all the uncertainty around the tariffs, if you cut 25 basis points or even 50, would it matter that much? So if we can get the tariffs out of the way, some of the like the China, China, and India, Korea, then those cuts later on in time may actually have more impact.
Yeah, I think that's another good point. And I think that the Fed is probably, in my opinion, spending a little too much time on tariffs and their impact. Because again, I tend to think that they're going to be a one-time show, as opposed to something that is something you're going to have to worry about in terms of inflation on a serial basis. But by the same token, the Fed has a lot to worry about. And you also have to give them a break because they booted it big time a couple of years ago, right? So, I mean, they made the mistake of letting inflation get out of control. And so it stands to reason that if they were going to make a mistake, they're going to make a mistake more on being a little too tight this time around than too easy.
Fair enough. Fair enough. We hadn't seen inflation in practically a generation. We were begging for inflation, and we got it good and hard. Switching to some more specifics, you had a great call on SMR earlier this year. I'm ashamed I didn't get in on it. Do you still like SMR, and do you have a similar call for something for the second half?
Yeah, so we run a couple of portfolios at Strategas Asset Management, and one of them is the Strategas Macro Thematic Opportunities Fund. So we pick three or four themes that we think are important. We rotate the themes. And SMR, New Scale, really was in our industrial power renaissance theme, which we still have. Another name I would say for another theme is a company called Red Cat, RCAT. And that's a company that provides software, services, support for drones. And that's part of our deglobalization theme. And we like that stock. We just added it to the portfolio. Again, we do it on a top-down basis. That is an important part of SAMT. And I would say, if you don't mind, a little plug for our ETF, it's outperforming the S&P handily year to date and over the last year. And by handily, I mean thousands of basis points.
What's the ticker for that again?
It's SAMT.
SAMT. Okay. I'm going to take a good look at that, and I'll take a look at Red Cat. And I'm still bummed I missed out on SMR. That had a great run.
Yeah.
You think that still has some more in it? Is that something you're continuing to hold on to?
Oh yes, it's still New Scale is still in our portfolio. It's still in the industrial power renaissance idea. That's going to probably stay there for a while.
Outside of the U.S. or I mean, Europe had a great run. Korea's had a great run. Do you any short sectors, countries that kind of jump out at you that you want to keep an eye on and you think it represents unusual value?
Well, I like Japan. I do think that this idea of populism is generally good for stocks, for risk assets, at least at the beginning. And clearly, there's been a change in Japan's political backdrop recently. And I think if you marry that with some of the traditional reasons to belong Japan, which would be big time corporate reform, that's good for shareholders, the valuation clearly relative to the United States, an alternative to China, those sorts of reasons I think are something that makes me as an American investor look around and want to own Japan.
And how would you own Japan, if I might ask? Is there a specific that would you just buy the index or a certain
I would
sector?
buy, yeah, again, I would buy the index. I wouldn't make it too complicated. I would buy the Nikkei.
Last question. Everyone's talking about AI. There seems to be a lot of folks who think that AI is going to cost a lot of jobs, but it seems to me that every time we've had a great breakthrough in innovation, it seems to have grown new jobs. Are you worried about AI? How would and how would you look to invest in AI?
I tend to agree with you in that I productivity tends to lead to other industries that you never would imagine would exist. And so I think with each new technology, there are fears that it's going to put someone out of work. And of course, that may be true in the short term, but I also think the productivity that's created, especially from artificial intelligence, can be so great that the society can absorb that and they can find other jobs within the economy in new industries that have been created by artificial intelligence.
Is there a good way to invest in AI, or just too early and they're just some of the names are not publicly traded?
Well, listen, we focus very much on publicly traded companies. Artificial intelligence is one of the themes in SAMT, and I think we're trying to think about it creatively, which is to say, some of the companies that will benefit by the learning models and the data they're collecting from their customers. So, a company like Robinhood, for instance, Netflix is another one. It's hard to leave out Facebook, Meta, given the capital spending they're putting into the technologies. But JP Morgan could be another one where they have the resources and they have to use it effectively to not only cut costs but also make the client experience much better. So I think you put all those things together, you can find other things that are that are going to benefit from AI.
That's a great idea. Sort of using it by buying it by proxy. Well, Jason, thank you so much for joining us today. Thank you for the insights. I'm going to look at SAMT and your other suggestions, and I hope to talk to you again soon.
Thank you very much.